joining, Joe. I think I've been trying to get you for this interview for the last 3 years.
Great to be here.
You saw a little bit about what KKR is up to. It's a roughly $640 billion asset manager today with ambitious goals to expand to $1 trillion under management by 2030, and it's closely being watched across Wall Street. And we're going to get to some of the things underpinning those goals, but first we're going to start with a big view on where the world stands today. And as we've been talking about, Joe, in the US, investors are trying to shake off that tariff hangover that exists right now. The markets have been very jittery. Investors are digesting how these trade policies could be in the future. How do you view the impact from your seat?
Sure. I think it's obvious to everybody that we're in an environment right now where there's a lot of uncertainty around trade tariffs, but it's not necessarily new. Even with the first Trump administration, he was focused on tariffs and trade. Biden kept most of those tariffs in place. So I think in our business, we're very long-term investors. We need to be thinking about these issues over time, not just in one administration. And what I'd say is, we have teams at KKR who focus on all these areas of macro risk, whether that's currency risk, tariff and trade, geopolitical risk, regulatory risk, in each of the different markets that we're investing in. I think this issue around supply chain security and resiliency, which relates to tariffs, is obviously front and center for all long-term investors. But people are trying to parse through what this all means. The final policies are not in place. The actions of other countries and governments in reaction to what Trump may or may not do is still unknown. So it's very fluid at the moment. And I think that's obviously creating some uncertainty and volatility.
It's interesting. In conversation with you, you had mentioned that this was a risk that you should have seen coming in a lot of ways. So from where I'm sitting, it looks like KKR has been preparing for this in a way that many investors have kind of very obviously have not been. So what have you been doing to prepare for all of this uncertainty, knowing that there's even more of it ahead?
Yeah, so I think we have over 150 companies in our private equity portfolio around the world. So again, supply chain resiliency, multiple sourcing avenues for our companies has always been a part of the risk mitigation approach. And we've spent a lot of time really over the last 5, 6, 7 years understanding that risk and mitigating that risk. And when it comes to new investments, I think a big part of our job thematically is understanding the risk environment we're in and choosing those themes and sectors and opportunities that really have less exposure to tariff risk or trade risk. So maybe a couple of examples of that is, healthcare services are very domestic, whether it's in the US, Europe, or Asia. That's an area where we feel like the tariff risk, at least, is not a pronounced risk. You could look at certain services businesses. We've made a number of investments in companies like home services, foundation inspection, maintenance companies in the US for an aging housing stock. You look at IT services and software investments in different countries. Again, very little tariff risk. So you're able to really zero in and target those industries and sectors where you don't think this is going to be a big problem.
When you think about the ripple effects that you might see from the tariff strategy, there are a lot of concerns about inflation,
Sure.
growth. How are you thinking about the economic headwinds that the US is facing?
Listen, I think that's one of the big uncertainties out there that people are trying to figure out. Tariffs are inflationary by design. So I think if that leads to an escalated level of inflation in the US economy, obviously that's going to slow GDP growth. It may put some pressure on the Fed, obviously, in a more tough economic environment to lower rates faster over time. But we've always felt that the bigger trends happening in the world, whether that's energy transition, the massive investments into data, a lot of these things are inflationary by its nature, putting aside tariffs, right? So we have a higher resting heart rate for inflation globally today than we've had in the last decade.
And you expect that to continue?
And potentially even get higher inflation, right? If these tariff and these trade wars continue, it's not an unreasonable expectation that in the near term, you could see higher inflation.
Well, doesn't that mean higher rates? Or do you think that the Fed is going to have to lower rates into the face of that? People are starting to use the word stagflation an awful lot these days.
I think it's going to be different in different markets. And I think the Fed's going to have to be very nimble in how they navigate this risk. Obviously, if the US is headed towards an economic downturn, cutting rates is probably going to be the policy response. If rates are high and we're not headed down that recession path or deceleration of growth path, then rates could actually go a little bit higher in the near term.
So let's look at this from a global perspective as well. I think one unique view you can bring from KKR is that you are very global in nature. So you see the way that the changes are happening in the tariff strategy, the way that nations are kind of separating in their relationship to each other. You see that on the ground through your portfolio companies.
Yeah.
What are then other areas of the world that are maybe even more attractive to you than the United States right now?
Well, I think it's not a secret. You had it up on the slide. We're big fans right now of Japan. We think that is a really, really underpenetrated opportunity, especially among U.S. investors. They really haven't figured out how to get the exposure they want in a market like Japan, where they're coming out of 2.5 decades of deflation. So finally, positive wage growth, pricing power, inflation is very modest, but positive inflation right now, and rates are actually increasing modestly in Japan. That's a completely different macro picture than what we've seen in Japan for the last 3 decades. And a really exciting time when you marry that with shareholder reform, activism, corporate governance reform in that market. Outside of the United States today, Japan is the largest destination of our capital.
So it's interesting. In addition to Japan, KKR has maintained a commitment to China as well. In fact, there are big deals that are in the market that KKR may be involved with at this very moment. So a lot of other investors are very worried about China, the internal economics and the relationship that China has to the United States.
Yeah.
How do you view that dynamic?
Yeah, listen, I think the geopolitical tensions right now obviously are front and center for us as we think about where to invest and how to invest. And in China in particular, you have to avoid those sectors that have sensitivity on both sides of the ocean, both the US government and the Chinese government. So we have not invested in some of these sensitive sectors like electric vehicles or semiconductors or AI. That's not the focus of our China investment strategy. We're really focusing on super high quality domestic businesses that are around domestic consumption and services. So in our portfolio today, we have one of the largest, or the largest Chinese pet food company. Again, geopolitically not sensitive. We own one of the largest pharmacy chains in China. We own the largest white mushroom grower in China, all geared towards the domestic market, a growing middle class who wants higher quality goods and services and food. And I think that's the sweet spot of where we're focused in the market today.
Now, that's interesting because even if you're focused on the Chinese consumer, that might be a little more insulated to, let's say, the global macro challenges. There are a lot of concerns about the Chinese economy.
Yeah.
Why are you seeing through them?
Yeah, listen, I think the overall long-term trend in China is the middle class is growing. And the expectations of the middle class are really for higher quality goods and services. Safer food, safer services. And that's what these companies that we're investing behind are really catering towards. No doubt the macro growth in China has slowed from a decade ago, right? You were talking about a country growing at double digits GDP. They're targeting 4 to 5% growth today, right? So there has been a slowdown. There's clearly challenges in terms of the real estate market in China. And you have to factor all that in terms of the growth rate you're underwriting and largely the entry multiple. The Chinese stock market today is one of the most interesting value markets in the world in terms of the multiples. So if you know what you're looking for, the type of risk you're trying to mitigate against, you could still find some interesting opportunities.
Yesterday I asked the question, is American exceptionalism dead? In addition to that, I ask you, is globalization a diversification play? Is it a safety trade? How do you think about it?
Well, we are a very, very global firm, and we have a lot of different ways to participate in those opportunities. Private equity, real estate, private credit, and infrastructure. So in really volatile periods like we're in right now, having that flexibility of capital, we could partner with companies, management teams, as a provider of anything from senior investment grade debt, right, to non-investment grade debt, to structured credit solutions, structured equity solutions, growth equity capital, to buyout capital. So, today it's an interesting market. When volatility spikes, that usually leads to really, really interesting deployment opportunities for our firm. You need to be nimble. You need to have the local reach in all these different markets. But we're excited, quite frankly, about 2025. There are going to be hiccups. There's going to be some headwinds in terms of some of these macro policies. But our ability to deploy scaled capital around the world, we think, is quite high.
I will still ask you, if not dead, then is American exceptionalism then overblown?
Now, listen, I think this notion that the U.S. is going to win alone has never been the case. I think the strength of the United States is really the resiliency of the economy, the strength of our capital markets to mobilize capital to support companies in the private sector, and labor productivity, right? When you think about why the U.S. has grown faster than Europe or faster than Japan, it's really about labor productivity in the United States. A lot of that is technology-driven and innovation-driven, but a lot of that is our unique mobility of labor in this country, right? You think about Japan, which is going through this resurgence. You know, structurally, they've done the best job of any country in terms of women participation in the workforce, people working longer in Japan, right? They've got real demographic challenges. They've done an excellent job around automation and robotics in their industrial base. But they're not getting the labor productivity because the mobility of labor in Japan is quite constrained. And their investment in software and tech is a fraction of what you see in the United States, right? So the real superpower of the United States is labor productivity at the end of the day.
I do want to spend the remaining time here switching gears, talking about the future of KKR, because it's been fascinating to watch the change from an iconic private equity company to what you are today. There was the full acquisition of your insurance company last year, Global Atlantic, and it's made KKR look more and more like Berkshire Hathaway. And there's one part of your business that's far less understood that I think makes you look like the most like Berkshire Hathaway, and that's your strategic holdings business. Many people don't know that KKR owns 18 companies on your own balance sheet at KKR. What is this business going to be in maybe 10 years, and why is it valuable to you?
Sure. So when you think about KKR as a business, we really have three core strategic parts of our business strategy. Asset management, I think, is well understood. It's what we're known for the last 50 years. So that's our third-party private equity, again, real estate and infrastructure, private credit business. And that's the $650 billion business that you mentioned at the start. The second big pillar of our business today is Global Atlantic. It's a 100% owned insurance company in the life and annuity space, roughly $190 billion of AUM there. And again, playing into all of these trends around retirement savings, retirement security, and being able to offer individuals compelling products for their own long-term savings. The third piece of it is a segment that we introduced last year at our Investor Day, but it's been a segment we've been incubating for well over a decade now at KKR, and that's strategic holdings. So what we're trying to build in strategic holdings is, in some ways, a mini Berkshire Hathaway, right? These are companies where we own large stakes, sometimes controlling stakes, sometimes not, but businesses that we think we could own literally forever, businesses that have the potential to compound in mid-teens over a very, very long period of time, very defensive in nature. So we have 18 companies in that portfolio today. We're going to continue to redeploy our free cash flow at KKR to invest in more of these types of businesses. And it's not just private equity. Over time, it's going to include certain platforms, probably in infrastructure and real assets, maybe certain buildups, that we're going to do in different sectors. When Scott Nuttall and I, my co-CEO, joined KKR back in 1996, Berkshire Hathaway had a market cap of $40 billion and roughly an NAV balance sheet of $40 billion. You fast forward 28 years, they have $1 trillion market cap on the back of long-term compounding of their balance sheet and their investments, right? Some version of that is what we're going to be doing with strategic holdings, but leveraging all of the skills and expertise we have in our private equity teams, our infrastructure teams around the world.
So what's an interesting parallel here? If you think about Berkshire Hathaway, is it almost like Global Atlantic is your own Geico, and these future infrastructure holdings will be your BNSF, and your private equity holdings would be kind of like your stock portfolio?
Yes, it's an imperfect analogy, but directionally you are absolutely right. I think, listen, strategic holdings for us, you got to think about it as a way, how do we think about redeploying our free cash flow as a business back into the most attractive areas? Some of that might be in our traditional, third-party asset management business, right? If we find great ways to deploy capital across those investments, we'll deploy that capital. A lot of the capital is reinvested back into Global Atlantic. We acquired our first controlling stake in Global Atlantic in 2020, and GA at that time had around $70 billion of AUM. 4 years later, it has $190 billion of AUM. So we've supported that growth with more investment. And then this third segment of strategic holdings, obviously, which is what we're super excited about, is one where we're going to be continuing to invest a lot more of our free cash flow as a business. So our guidance to the street today is by 2026, that portfolio will be generating around $350+ million of after-tax dividends for us. That's growing to $700 million by 2028 and $1.1 billion by 2030. So it is a very, very visible, recurring, growing cash flow stream at KKR.
So you essentially have a kind of a future unicorn of sorts being built inside of KKR. If you're going to be bringing in $1 billion over time in this business, do you think it's built into KKR stock, that assumption yet?
I think people are starting to appreciate what we're trying to build. But I think the bigger picture is when you look at our universe in the alt space, 5 years from now, 10 years from now, I think many of the public peers in this sector are going to actually take very different approaches to how do they grow their firms. I think the approach we have with third-party asset management, insurance, and strategic holdings is quite differentiated and different than the way most of our peers are trying to grow their firms today.
Now, I want to spend a little time talking about not just institutional capital and how you are deploying capital in your own balance sheet. We've been talking so much about how there's been a massive push for retail when it comes to the world of private assets. Everyone is doing it differently. You have a relationship with Capital Group in order to make this available in a mutual fund form. So how available is it to invest in private assets from where you're sitting? What's the minimum amount you would need to put into a fund to start to get access to what you're offering?
Sure. So the way to think about the bigger picture opportunity is, for most of our history at KKR, we were founded in 1976. Our core client base was really large institutional investors, pension funds, insurance companies, sovereign wealth funds around the world. The individual investors who participated with us were really ultra-high net worth families and family offices who could allocate capital as part of their diversification as really LPs in our funds. They were sophisticated investors willing to take that 10 or 12 year illiquidity risk, just like a pension fund would. So that's a very small percent of the households, obviously, in the United States. But that's how they've accessed and partnered with us historically. What's relatively new for us in the last 2 to 3 years is we've introduced a series of private wealth products for individual investors who are accredited investors. Okay, so those are investors with a net worth of, call it $1 to $5 million. These open-ended evergreen products have semi-liquidity features, so you're not locking up your capital for 10 to 12 years. You have the ability, if you need it, to redeem a portion of your capital every quarter. So it's a slightly different format, but it's investing in exactly the same deals that our flagship funds are investing in, right? So we're trying to deliver that same institutional quality experience, the same portfolio, the same access to deal flow, whether that's in private equity, real estate, infrastructure, or private credit, to individual accredited investors, right, in that $1 to $5 million in net worth. That's around 10% of the households in the United States in those first two buckets, ultra high net worth and accredited investors, and roughly half the AUM in the individual channel. With Capital Group, we have an exciting new partnership which really addresses the next 90% of US households. These are mass affluent individual investors who probably wouldn't be buying our private wealth product and wouldn't be LPs in our traditional fund. So we're creating hybrid products with Capital Group in a mutual fund format. We're starting with credit in the second quarter, where we're going to be putting a portfolio together where Capital Group manages the public credit. We will manage the private credit allocation in that mutual fund and deliver a product to the mass affluent that looks very different from anything they've been able to buy before.
It feels like the holy grail for this industry is making private assets available in 401k plans.
Yes.
How soon do you think that happens? And if not that soon, what's the biggest barrier?
Well, listen, I think, again, at a high level, when you think about some of the societal challenges we have, a big part of that is securing your retirement, right? As you retire from work, people are living longer. The demographic trends are pretty clear. Individuals need to have more agency and control of their retirement security. So the question is, how can policymakers working with the asset management industry create more of that long-term security for savers and retirees? Historically, individuals have not had access to the alt space, which is what we're talking about. Certainly not through their 401k plans. So the opportunity is really over time to create a pathway for those savers through their 401k plans to allocate a certain portion of that to the alt space. That's going to require government regulatory policy change. And again, I think this administration is probably more open-minded to that. But if Social Security is going to come under pressure and corporate pension plans are going to come under pressure, again, from a societal standpoint, individual investors need better ways to compound their wealth in their retirement.
Before I let you go, I want to go back to one more question about that strategic holdings business, because I know it's one that a lot of people don't know a lot about. I know even all your rivals are watching very, very closely. You have 18 businesses that you own. How many more businesses are you looking to buy, and what would it take to be the next business to be owned by KKR on your balance sheet?
Oh. Listen, I think we are looking for, again, businesses that we would be happy to own for either a very long time or forever, right? Businesses that we think can compound equity value at mid-teens plus kind of rates. Businesses generally that are very defensive, cash flow oriented in nature. So when you think about that kind of profile, you know, it's actually not a lot of companies that you'd want to own for 10, 15, 20 years, right? Very, very few. So the bar set very, very high for what goes in strategic holdings. But again, it's not just it's private equity today, those 18 companies. Over time, I think what's exciting is we could think about infrastructure in a different way. We could think about build-ups in a different way. So the strategy there is going to evolve over time. And it's really a question for us. We're going to generate as a firm $25 billion of free cash flow in the next 5 years. How do we want to allocate that capital? How much of that should be used for strategic holdings? How much of that should be used to grow our insurance segment? And how much of that, again, should be used to expand our asset management business? The answer is all three are going to get investment. It's just where are the best opportunities?
As we do at Bloomberg, we will always be on the hunt for your next deal. Joe, we thank you so much for your time here. We thank you all for being here. Appreciate it.
Thank you.